Video conferencing giant Zoom announced a massive $14.7 billion acquisition of cloud software company Five9. Now, what I'm going to do is I'm actually going to explain the quantitative and qualitative aspects of this deal. I'll also explain how the investment bankers pulled off this deal, and I'll discuss how hedge funds are transacting in Zoom and Five9 right now. So from a qualitative perspective, the deal makes sense because Five9 is a call center software company, and a lot of call center employees are, of course, working from home right now. And Five9 is actually a brilliant name for the company from a branding perspective because Five9 is a call center software company because Five9s right here is what large technology companies talk about when it comes to uptime and availability of their products 99.999% of the time. Now, from a management integration perspective, the deal also makes a ton of sense as the CEOs of both Zoom and Five9 worked together at Cisco years ago when Cisco bought WebEx in 2007. I remember that deal very, very well. And from a quantitative perspective, this is the second largest technology M&A deal this year behind Microsoft's $16 billion acquisition of Nuance Communications. Now, usually when a large-scale M&A occurs, the premium that the acquirer pays is about 25 to 30% in normal environments, normal markets, that is. Microsoft bought Nuance Communications earlier this year for a 23% premium. And I mention this because with Zoom paid only a 13% premium for Five9, partially because valuations in general in this market are at nosebleed levels. And what was fascinating about Zoom's deal is that it was an all-stock deal. And when you see an all-stock deal, it often signals that the acquiring company, meaning Zoom in this case, knows that their stock is overvalued and that it's very smart to use their stock as currency instead of using debt or using some cash to finance the deal. Now, the shareholders of Five9, the company that Zoom is acquiring, the way it's going to work is they're going to receive 0.5533 shares of Zoom for every share that they own. Now, if we go to Yahoo Finance together and we type in the ticker for Five9, let me show you how to get the share count here. So if we go here to finance.yahoo.com, and please never pay for any software or website access when it comes to information on investing because nobody's smarter than you and everybody's biased. But if we go here and we type in the ticker for Five9, which is FIVN for Five9, and we go here to statistics, we're going to see the share count. And this will make a lot more sense to you in a second. So I'll do a quick search for share here. Here we go. Great, cool. So the shares outstanding are 67 million shares, as you can see right here. When it comes to Five9, if we take the 67 million shares, okay, and we multiply it times 0.553, that results in 37 million shares of Zoom that Five9 shareholders are going to receive. So 37 million shares times Zoom's stock price of $363 when the deal was announced implies here a price of just over $200 per share for Five9, which is a 13% premium. And 363 times 0.553 means that when the deal was announced, each Five9 shareholder would receive about $200 per share, which is the 13% premium. However, since Zoom has now pulled back since the announcement of the deal, this means that as of now, the Five9 shareholders won't receive that much of a premium at all. So with Zoom at about $351 per share as of the close of the market yesterday, that means that the Five9 shareholders will get, as of now, $194 per share and not the $200 per share. So Why is Five9 share price several dollars below $200.80 right now? Now, there's a couple reasons why. Number one, the market is implying that Zoom stock is overvalued. And two, most importantly, in most cases, when one company announces that they're buying another company, unless there's an expected bidding war for the acquiree, meaning Five9, what happens is a stock getting acquired, Five9 in this case, stays a little bit below the announced price, just in case the deal falls apart. Why would the deal fall apart? It could be, number one, if the owners of the company getting acquired vote to stop the deal, or number two, if the government antitrust departments block the deal, just like they did when Microsoft tried to buy Intuit in 1994. And what happens is governments block deals if they think that the deal is going to hurt consumers from a price and from an innovation perspective. As we all know that, monopolies are lazy when it comes to innovation, and they increase prices. That's why Warren Buffett loves to invest in monopoly-based companies. Okay, let's move on now to discussing hedge funds' roles in the deal. And then what we'll do is we'll wrap up this topic with a quick discussion of the roles of the investment bankers that structured this deal. Now that the deal has been announced, what happens is this. Massive event-driven hedge funds staffed with an army of lawyers analyze if the deal will be approved and will actually take place. So what happens is this. These massive event-driven hedge funds, what they do is they buy, meaning they go long the company being acquired in size, meaning in this case, Five9. Okay, they go long Five9. And what these hedge funds do to hedge their bets is they go short, meaning they bet against the company making the acquisition, which is Zoom. Now, why do they do this? Well, I've worked for very large hedge funds in the past, and I've done a lot of event-driven deals. And what happens is there's an arbitrage opportunity as the company getting acquired trades at a bit of a discount to the price announced, especially if it's a fixed price instead of a deal based on the acquiring company using their shares as currency. Okay? Now, let me give you an example first. If company B is at $10 right now, and if company A agrees to acquire company B for a 30% premium at, say, $13, then the market often drives the price of company B up to just below $13, maybe 5% below $13 initially. And then what happens is this. The event-driven hedge fund buys company B for where it's at, which is currently just below $13 in this hypothetical case. And then what they do is they short company A in size. And eventually what happens is company B, if all goes well, sells itself for $13, okay? And what happens is hedge funds make a massive profit as they use a ton of leverage to buy the company being acquired, and they short in size the company making the acquisition. And that arbitrage spread closes, meaning if the price is just below 13, when the deal closes, eventually it goes up to $13. So if the deal does not go through, then the hedge fund is in big trouble. And quite often what happens with massive M&A deals is they don't officially close until 6 months after the deal has been announced, because shareholders and antitrust groups need to approve the deal. Also, in normalized economic environments, interest rates are much, much higher. And there's an interest rate-based discount on the deal given the time value of money. Now let's talk about the role of investment bankers in the deal. In most cases, what happens is this. Big firms like Zoom that do an acquisition are represented by one large reputable investment bank. So in this case, Zoom is being advised by Goldman Sachs. And a different firm always advises the company being acquired. And the best way to think about this is think of investment bankers as being like lawyers, as you actually would never have the same law firm representing two firms in a trial. So when it comes to Five9's investment bankers, they have the #1 technology investment banker on the planet representing them, which is Frank Quattrone from Catalyst Partners. The guy is a rock star. So Frank Quattrone from Catalyst Partners is a legend, as he's put together many incredible deals in tech over the past few decades, as he's known in the industry as being the smartest technology investment banker in history. And I know this as I pitched my portfolio companies to his firm when I worked in the venture capital sector. He's great. Now, my gut is that it was Frank Quattrone who approached Five9 and suggested that they sell themselves to Zoom. And a deal this big in technology often has Frank Quattrone involved. So how do the investment bankers make money if the deal goes through? Well, what happens is they get a fee that can be a couple % of the dollar value of the transaction. And this is why investment bankers make the big bucks. So how do we learn about this deal instead of just relying on the biased media? So here's what you do when a deal is announced. You go over to sec.gov, okay? And sec.gov is the Securities and Exchange website, which is governed by the US government. And to be on the stock market, you have to actually register at sec.gov, and every little piece of information that's disseminated to the public has to be posted here first. So you and I get access at the exact same time as all the big hedge funds do to market information. So let's type in here Five9. Okay. And what we'll do is we'll go to 8K. Okay. Now 8K means an important press release. So let's click here on the most recent 8K. And we see here that this 8K, and I won't go through the whole thing, I promise you, but it talks about the merger with Zoom. And what's important to look at in the 8K when you're doing your research on M&A is you always want to do a search for the termination fee. Okay, and let me go through here. There's 4 instances of this. This will make sense to you in a second. Okay, here it says there's a termination fee of $450 million in cash. And so what happens often is the company making the acquisition, what they also do is they hold a webcast. Okay, it's a conference call to talk about the deal. And they take questions as well. And anybody on the planet can listen to this. So you and I by law actually have, which is amazing, you and I by law have the same access at the same time to all financial information that the top hedge funds and mutual funds do when it comes to sec.gov, or if we go to the investor relations website for the companies involved with the deal. So let's go there together quickly. What we'll do is we'll do a search on investor relations Zoom. And what we can do here is we can actually listen to events on Zoom's website. So what happens is we can actually access this call, which has already taken place, but you can watch a replay as well as look at all the slides as well. The bottom line is that although the Zoom Five9 deal makes sense from a qualitative perspective, the fact that this is an all-stock deal, meaning Zoom is not paying for part of the deal with cash or debt, this is an all-stock deal. And this reminds me a lot of when AOL merged with Time Warner in late December of 1999 in an all-stock deal, just a few months before the NASDAQ peaked in March of 2000, given egregious valuations. Now, if this was helpful, please like, subscribe, and comment. And thank you.